Hi pension subscribers and welcome back to the channel. Today we're going to be talking about the pros and cons, or the advantages and disadvantages of pension lifestyling. Okay, so a lot of you will be saying, what is pension lifestyling? Why are you talking about it and why is it interesting? So I'm going to bring Jonathan from the office in London into today's video to give us a little bit of a summary. So Jonathan, if you could start off a little bit of your experience recently with pension lifestyling and some of the stuff and reports we've seen of late in the media.
Yeah. Hi viewers. Yeah, so first off the bat, let's remove any confusion here. We are talking about lifestyling of your pension funds, not lifestyle financial planning, which you'll probably hear me and Dominic and any of our other advisors going on and on about during any of our review meetings, which is the service we provide. So what is lifestyle pensions? Essentially, what happens is you've probably heard this old adage, as you get older, you introduce more fixed income bonds into your portfolio with the idea that bonds are more stable than equities. They don't go up and down as much. And as you age retirement, you can't afford to take on as much risk because you have less years to claw back any lost returns. So we add bonds to ostensibly de-risk you, which means as you get to retirement, you are taking on a lower level of risk, you are more stable, and you're more unlikely to be the the person who has to deal with a big loss just for retirement. Lifestyling became very popular after the pension freedoms were brought in. It was actually still used before then, but where lifestyling come about from, it's tied to the old annuity style purchase. So the idea was, as you got closer to retirement, they'd add in all these bonds. Whatever happened to the bonds, even if they lost value, it doesn't matter because you were just going to sell the whole portfolio, and buy an annuity at the end anyway. And because bond prices move at the same way as annuities, so if bond yields go up a lot, annuities become a lot cheaper, then it doesn't matter because your pot that's fallen can still buy it at the same level of income because the level of income is cheaper.
Yeah. And why would you say pension lifestyling exists? Why would you say it's been sort of, we could say, pushed into client portfolios and UK pensions?
Risk management, really. Most schemes, especially when auto enrollment came out, have to offer a default strategy. Now, everyone is different, which is another complaint about lifestyle funds. But in this context, it means that, if you just have a fund, like a 60-40 fund or whatever, that won't work for everyone in a scheme, because some people in the scheme will be 21 and some will be 71. And, they are not going to have the same portfolio. So where lifestyling comes in, there will be a set rate where you get to a certain age where it's 100% equity. And then as you age, they will introduce bonds to the portfolio. It's a default option. It's a one size fit all, and it's just tied to your age. So as you age, bond exposure increases, and that's the same for everyone. And, it's based on, some flawed reasoning around what risk is, but it's based on a framework that does have some basis in historical fact. So no, it's very hard to go to your scheme, you put me in the wrong thing, because it ostensibly does fit the bill. But there have been a lot of issues that a lot of financial advisors and people in the investment industry could have seen coming a mile away, that we'll get into in a second.
And what would you say, out of all the times recently that you've seen lifestyling funds inside, typically speaking, when you're doing defined contribution pension transfers, what has been your views of the funds in terms of things like their performance, their cost? Do you think they're providing good value for clients?
Yeah, so ironically, sometimes the cost is quite good. They're not necessarily the most expensive, being the default and being a slightly newer thing. The problem is the performance. Now, if we were robots and we took on no emotion and we didn't make financial decisions emotionally, the statistics would tell you that you should have a 100% equity portfolio. Bonds, no. Gold, no. property? No, 100% equity. If you were a robot, if you ask ChatGPT, what should I invest in? It will tell you 100% globally diversified equity. The problem is, we're not robots. You know, the stock market falls 45%. You're probably not going to have a very good night's sleep. Now, that's where the idea of introducing bonds in, because the idea is, instead, you know, if you've got more bonds in your portfolio, when the markets fall 45%, you only fall 20%. But the big problem is you lose the upside. So when you add bonds to your portfolio, you are giving up expected returns. You know, 100% equity might be expected to do 8 or 9% over the last 70 years. That's what it's done. But as you add bonds, you are giving up those returns because you don't want this. You don't want volatility. And essentially, you know, the way we work at Cameron James, and the way it really should work is you should have as much equity as your portfolio as you can stomach, as you can take, as your risk profile can take, as your other assets. But it's all about, if you can take it through thick and thin, you should have as much equity as possible. But a lot of people can't, because it's not worth it. You know, there's no point having loads and loads of money at retirement if you're, you know, struggling with high blood pressure by the time you get there. You know, as I sometimes say to clients, the best portfolio for you is the quote unquote riskiest portfolio that you won't panic and make changes to. You know, that's how that kind of works.
And how would you say, obviously 2020 is a good example of that, volatility in the market. I think any client who invested at the start of January 2022, by the end of the year was almost certainly down, irrespective of their risk profile. Obviously, the higher adventurous portfolio is losing more. How have you dealt with that over the course of the year, Jonathan, with clients who have been down? What do you say to them? What type of emails do you get from clients? Just a bit of commentary on that.
Yeah, so just to kind of add why clients have been so down, you know, I've had some clients, you know, a good example, he's actually a very good follower of this channel, so I know I'm probably going to get a WhatsApp message when this comes out to say, oh, you're talking about me. You know, not to give him PTSD again, but, you know, he had, so Aviva is a very common user of these, and they are one of the, you know, Aviva is a fantastic company, but their lifestyle funds did particularly poor in comparison to others. And I'll explain that in a second. Now, that is because, as I just mentioned, you should have as much equity risk as you can stomach. But what happens is, your default strategy lifestyles you, reduces your equity, increases your fixed income, you know, reduces your expected returns. But what went really wrong last year was, typically speaking, if the stock market crashes, bond prices rise. Yields fall because people go, oh, I'm going to sell my stock and buy safe haven assets, i.e. bonds. Now, the problem is, last year, the reason why the stock market fell was because of interest rates, because of bond prices. Because bond prices fell, interest rates went up, and because of the makings of the market and where a lot of the perceived value was derived from low interest rates, they fell together. And what you found happening is actually, last year, whilst the global markets, and especially the US, fell, you know, 15%, the bond markets fell 20%, and long-term bonds fell even more. And you know, you know, take it tangentially onto DB schemes, the very reason why your transfer values have fallen so heavily is the very reason why lifestyling funds have fallen so heavily, because they bought long-term assets to match you into kind of an annuity style purchase. You had very long-term bonds. It's called duration. You don't need to go to, basically, the higher the duration, the more sensitive the price is to interest rate changes. That's all you need to know. And because interest rates went up 5%, you know, in the US, you know, not quite as high here, although, you know, they might be heading that way these days. They because they had long-term bonds, they fell 40%, 50%. So, you know, this client I was talking on to, you know, in the first 6 months of 2022, his ostensibly safe, get the word they use for it, it's coming to me in a second when they use it, consolidation phase, as they sometimes call it. It was supposed to consolidate before he retires, fell 45%. Now, that's terrible, but there wouldn't have been such a big problem if he wanted to purchase an annuity. But he has absolutely no interest in purchasing an annuity doesn't fit him. He wants drawdown. So he's lost 45% of his pot right on the outset as he retires, and he would look to access it, all because he was in a default lifestyle strategy. Had he been 100% equity, which allegedly is much higher risk, he'd have perhaps lost during that time period 15% or something like that, or maybe even less. Yeah. So despite taking what is allegedly considerably less risk, he lost 3 times as much money of his pension because he was in these lifestyling funds. You know, and to hark back to your question, what I say to clients is, you know, and it's tough love, but unfortunately, it's too late now. You know, the losses are there, and it's about what you're going to do with where you are now. And you know, I think lifestyle funds, you know, are not the type of funds that are going to shoot back up like equity markets are. So not only are you down a lot, the idea that staying where you are is going to be the way you're going to, you know, grow back up, because you're going to be adding fixed income during that time period. So you're going to have even less equity than you were when you lost all the money. You're going to have even more of the horrible bonds, or you know, during that time period horrible bonds. So you know, you've got to make a decision. And you know, a lot of the times I say to my clients, especially if they're younger or they're in one of the better ones that doesn't kind of as drastically boost your fixed income, switch it off, you know, turn it off, sell the consolidation fund, put it all into the growth fund. You have no need to do it, and we'll help you manage the risk exposure using your other investments or whatever, because invariably, you know, the de-risking, as they call it, funds are the problem. And you know, I'll have a client, I've actually just I've just provided an advice, done a big advice report for a client, finished it up over the weekend, and you know, he's in a very good scheme, very big pension provider, very well respected. One of the funds is very good, well, relatively good, you know, pretty stable fund, done pretty well. Unfortunately, the other one's a consolidation fund, and as we showed, over the last 5 years, had he have remained in 100% in this growth fund, you know, his portfolio would be 20% higher than it is now, because they put even, I think it was 30% into this consolidation fund over the last 5 years. So even though they put in, you know, 5% a year over the last 5 years, that has knocked 20% off his pot. You know, and he's a high risk investor, or especially with his other assets. He doesn't like bonds, but he's in bonds. And you know, that's the problem. And I think the statistic is, Dominic, I think you mentioned it on a few of the videos, you know, I think it's something like 95% of people in a workplace pension scheme are in their default fund, which is great if the default fund is a global equity fund or a global 70-30, 60-40 fund, great. If it's in lifestyling, probably not great.
Yeah. Yeah, so this is one of the key points for clients really, is that when you have your UK pension assets, as Jonathan just quoted, is 95% of people remain inside their default funds, unless you are a specialist or you've got the time and the energy to be going to look at page 28, 29 of your terms and conditions that you signed 9 years ago when you joined your DC pension scheme. Typically, you know, you've really got to have a specialist come and have a look at these bits and pieces for you. As Jonathan, thank you very much for your thoughts on pension lifestyling, really valuable. I think we've got a quite clear understanding of that for you. So pension subscribers, thank you as always. If you have a question for myself or Jonathan, please head down to the description section where you can book an appointment with one of us, or feel free to leave a comment below and we will be responding to you personally. And as always, take care with your UK pension assets.